the equity market today, if you look at the professional money managers, roughly 60% are Democratic voters. So the market basically leans Democratic on the equity side. In the fixed income side, it's actually opposite. I think it's closer to 80% are Republican. I think that it would be a really national benefit if secondary schools, like high schools, taught basic financial education. Like you said, dividend, power of compounding, balancing a checkbook, budgeting, because I think that fiscal responsibility pays dividends, because, the idea of like how a business works is actually how people need to run their lives.
The United States is in the middle of a war. Oil prices are near record highs. The S&P 500 just hit an all-time high. If you had told most investors at the start of this year that those two things would be true simultaneously, they would have laughed you out of the room. War plus an energy crisis has historically been the recipe for recession. And yet, here we are. Today, we're breaking down the thinking of Tom Lee, one of Wall Street's most closely watched strategists and the co-founder of Fundstrat Global Advisors. He's been consistently bullish when almost everyone else was running scared. And in this breakdown, we're going to find out exactly why and whether that conviction still holds as we move deeper into 2026. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
A lot of investors are surprised because the US is in the midst of a war that could be a long war, and oil prices are at record highs. And I think a lot of folks at the start of this year would said that this would have been enough to trigger a bear market or even a recession, but instead the S&P's at an all-time high, and the groups that led last year, like AI and semis, are the ones leading again. So I think it really speaks to me about the resilience of the US economy and maybe the continued very weak conviction of most investors. Well, in early December, we typically look at the year ahead and we write down what we think are the key drivers and kind of what the contours of the market would look like. So December 2025, as we were thinking about this year, we just thought this year would look a lot like 2025, which is a difficult year for markets, but ultimately very strong. But in the middle of that, we penciled in the idea that the market would test a new Fed, and therefore we would have a sort of start to the year that would be strong. 7,300 was an aspirational number at the time because the S&P was in the 6,000s. But then we think that there'd be a pause, and then the setup would still be positive because we think there were some structural tailwinds, and so we thought we'd end the year 2026 at 7,700. So the year is tracking the way we expected, although we're a bit above 7,300 right now. But if someone asked me today, well, first of all, can the S&P make its way to 7,800 first before drawdown? I think anything's possible. But I think what I am mindful of is that stocks were a lot cheaper at the end of March at the market lows. They're a lot less cheap now. So a lot of good news is priced in. And I still think that there is potential for turbulence in the middle of this year, and with maybe more reasons for it. One being, of course, the market testing a new Fed. But second is, I think it's still hard for me to reconcile that oil prices are not reflecting the acute shortage that's developing for petroleum products around the world. So I think that there's going to be some reconciliation maybe later this year. Penciling in my head just a quote like unknown right now, because to me, the current price of oil doesn't seem to reflect what will be the clearing price later this year, because we know inventories have been drawn down and we know there's a supply shortage and we know the straits aren't allowing normal traffic, and these are going to affect a lot of economies outside the US. And so as much as I want to take some comfort from like the futures price of oil, I actually don't think that reflects the price that's going to exist later this year. So to me, I'm going to just put it as an unknown, because for now the market doesn't seem to be bothered by it, but it could be that there's a resolution before the shortages get too great, or the market will be surprised in a negative way. So I actually don't know. all of them matter, and at different times, the market's going to care about something else. We've written about private credit recently. I do think that there is going to be losses, and software has a little bit of uncertainty, but I think the underwriting is probably better than most people appreciate for some of the private credit firms. So I think our general view is I think private credit is a problem, but it's not systematic. And we've done a lot of work on the software stocks. I do think a lot of the bad news is priced in because on a relative price basis, you're back to 15-year lows. So the entire software is eating the world thesis has been unwritten in just the last 6 months. So I think a lot of positive risk reward now exists in software stocks. And then with regard to the Fed, it's an unknown because we've got a new Fed chair. He's got some very specific views about the sources of inflation that vary from existing Fed views, and how to measure inflation also varies. So I think it's going to be now a time where markets want to understand how the Fed will interpret incoming inflation data. And we know that looking at history, 11 of the 13 new Fed chairs have seen a drawdown of at least 10% in the first year. So that's why I think later this year we could have some turbulence.
The market's current oil price does not reflect reality. Inventories have been drawn down. There is a documented supply shortage. Key shipping straits are restricting normal traffic. And the downstream effects on petroleum-dependent economies around the world are going to be felt. It's just a question of when, not if. Lee is careful not to predict a specific crash. He calls oil a known unknown. The futures market tells one story. The physical supply and demand data tells a completely different one. At some point, those two stories will have to reconcile. And when they do, markets that have been ignoring the signal will get surprised.
I think credit is an important signal, often a leading indicator for equities. It's a long-standing debate because when I was at JP Morgan, our credit teams, whether it's high yield or even on the mortgages, said they used to look at the stocks to decide what it would mean for the credits. But I would tell them in the same that I was always looking at high yield to figure out what would happen with the equity markets. At turning points, and we've demonstrated this, high yield leads the equity markets. So on downturns, I think one of the best ways to always make a bottom call is when high yield spreads aren't widening, but equities are still weak, because that tells us that the divergence is happening, so that we already know a structural bottom has taken place. I know people are looking today at trying to discern what, like credit, for instance, CDS is saying about stocks like Oracle, where Oracle CDS spreads have really widened. It's hard for me to say that that's actually signal, because, for instance, Oracle, if you look at where CDS stands now, it ranks 246th in the S&P 500. So in other words, it's got the default risk of like the midpoint of the market. So, I think if someone's saying Oracle is bankrupt because the CDS spreads have widened in the totality of like the S&P, that means like half the market has the same sort of credit outlook. I think it's important, but it's not always that clear cut for me. A few things. I'd agree with you. One of the reasons we've stayed bullish at Fundstrat is that the market psychology isn't consistent with a market top. I think in general, as you know, when markets are nearing a top, bubbles form because investors become overly confident about continued gains. And therefore, when markets decline, sentiment stays strong. And then, of course, as you know, markets fall on a slope of hope. But that's not what we've seen. Every time I think the market falls 2 or 3%, sentiment turns pretty bearish. And we see it both in sentiment readings, but also in positioning data. In this most recent downturn, Goldman's prime brokerage data showed the level of short increases was at the fastest pace in almost 15 years. I think there's a few reasons for that. One is, I think it's become easier for both institutional and retail investors to position square their entire portfolio. Like, I think there's push button liquidity. So now it's easier for people to, quote, rage sell and go to cash. And because of that, I think it means people's conviction levels are much more loosely held because they know everybody else has push button liquidity. The second is, I do think there's a political divide. We've highlighted this, but when you look at data from either Pew Research or others, including YouGov, the equity market today, if you look at the professional money managers, roughly 60% are Democratic voters. So the market basically leans Democratic on the equity side. In the fixed income side, it's actually opposite. I think it's closer to 80% are Republican. And as we all know, the current White House is quite divisive. And I think there is something, there's many people who might have TDS. And so that, I think, has colored people's views of both actions taken by the White House and how investors unfortunately interpret the data. Because instead of being unbiased and evidence-based, I think a lot of people still have their own subjective overlay and how they see information. So, for instance, when this war started, there's a lot of our clients who said, like, well, this is Armageddon. And they were not even just worried about, like with the stock market being down, they were worried about their own personal safety. So I do think that there is an overreaction in markets. The University of Michigan, I think, has also become notoriously partisan. We've highlighted this, that if you look at the composition of respondents, now University of Michigan went to no longer doing a phone survey, so it's online only, I believe. So every respondent now only responds online. And the response rate now is roughly 66% Democratic versus 33% Republican. That's not a fair breakdown of the US overall, because in general, the size of Democratic response and Republican are about equal, both 30%, I think, or 35%, and then independents are in the middle. But that's not how the surveyed respondents reflect. So the record low sentiment, for instance, we highlighted this in a recent report, for University of Michigan respondents hitting an all-time low. What was very incongruent about that was that the Democratic responses for current conditions is essentially unchanged since November, and the Republican responses are unchanged since like the summer. The only reason that overall number kept dropping is that it's reflecting a greater percentage of Democratic respondents. And the survey itself allows a lot of latitude. Like, if you look at the actual responses, I think it's 3,700 responses every month, or between the bi-weekly, but it's 3,700 total. If you look at the inflation question, I think 25% of Democratic respondents say inflation is currently running over 100% right now.
That's right. I was trying to guess what you were going to say, and I would have laughed the same if you said 10%.
Yeah, it's kind of, I think, polluted in the sense that people might just be making up numbers when they respond to that survey. First, foremost, just on financial education, I think that it would be a really national benefit if secondary schools, like high schools, taught basic financial education. Like you said, dividend, power of compounding, balancing a checkbook, budgeting, because I think that fiscal responsibility pays dividends, because, the idea of like how a business works is actually how people need to run their lives, because their own career is a small business anyways, and a family is a small business. But on the surveys, I agree. That's why I've been finding a lot of value in alternative inflation series like Trueflation. Trueflation measures, I think, 7 million products. It's all automated through APIs, and it's capturing real-time price move. In fact, Kevin Warsh, in his testimony at Congress, was talking about how he wants the Fed to move forward with their billion data set price analysis. And they want to just basically say inflation is the 500 millionth item, the median of all that. And I think it reflects the idea that surveys may not, if they're not conducted properly, are really polluted, and the Fed and markets actually get really bad insights. I mean, UMich is a great example, because if someone was trying to manage money off the University of Michigan survey, both on the inflation survey, which is showing chronically high inflation expectations, or the sentiment, they would have gotten the stock market wrong, because it's giving you very bad signal.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.